Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stock gains losing some steam as markets remain unsettled by U.S.-China trade tensions. Investors also hearing from the Federal Reserve and Treasury Secretary Scott Bessent. We're digging into the details of those stories coming right up. But first, there's just an hour to go until the closing bell. Let's take a quick look at the major averages here. The Dow tacking on about, call it 40 points. The S&P 500, your broad gauge, is up about 0.5%. Tech-heavy NASDAQ is up about 0.7% here. Let's welcome in data and markets editor Jared Blickery. Jared, what are you seeing in today's trading action?
Thank you. As you said, losing a little bit of steam, especially in the Dow, just holding on to some minimal gains there. Let's check out the intraday price action. We've been higher. We've been a little bit lower there in the red around midday. And right now, we're just above that flat line mark. But the NASDAQ holding on to about 0.8% of gains, or 0.75% there. You can see it also dipped into the negative rather recently. And the S&P 500, which is up about 0.5%, very, very similar chart. And so I'll also show the Russell 2000, barely red there, but gains of about 68 basis points or 0.7%. I have been tracking the VIX, and this is what's happened today. We saw a little bit of a rise here, and that coincided with a lot of the majors dipping into the red. I'm going to show you a 5-day view so you can see that spike up on Friday. That was when we got that China tariff, potential tariff announcement, and the VIX has remained elevated since then. 20.59 is not huge. It's not extremely elevated, but relative to where we were, it's worth keeping an eye on. That just shows you that institutions are still interested in hedging 30 days out. That's what it's measuring, 30-day options in the S&P 500. 10-year T-note yield, that is up about 2 basis points. I'll scale this back to a day, and you can see up there. And the 30-year, that is up 2 basis points to 4.64%. Meanwhile, the dollar going in the opposite direction today, the Dixie down about 0.25%. And in sector action, interesting to see real estate and utilities, the number 1 and number 2 slots, each of those up more than 1%, along with tech. And then in 4th place, we got communication services. All 4 of those are outperforming. And to the downside, we got industrials, materials, energy, and financials. Just financials barely in the red there. We'll check out that board in a second. It was pretty interesting. But first, the tech trade, the NASDAQ 100. Here's AMD up another 8.98%. I'll just show you what it's done over the last month. Basically 50%. That is impressive, and it looks like it's set for another record high there. Alphabet up 2%, Meta up 1%. And so the chip trade looking strong today. Here are the semis. I'm going to show you the software. It's a little bit different. You're going to see a little bit more red. So once again, the semiconductor trade a little bit stronger than the software today. And I promised some bank action. I'm going to hold off. I'm going to leave off on these. First, show you the big banks. And we got some results from Bank of America this morning, 4.72% to the upside. Morgan Stanley up 5%. By the way, Wells Fargo, throw that in there. That's up 2% as well. There is some red, but then check out the regional banks. Call it a lack of investment banking activity. We're seeing some outsized underperformance from PNC, FHN, WAL, and a lot of these names are going to be reporting earnings in the very near future. So we will keep an eye on these. Back to you, Josh.
We sure will. Thank you, Jared. Well, Treasury Secretary Scott Bessent takes aim at China amid rising trade tensions, and Yahoo Finance's Jennifer Schonberger joins us now with the very latest. Jen.
Good afternoon, Josh. Both Treasury Secretary Scott Bessent and U.S. Trade Representative Jamieson Greer slamming China in a joint press conference earlier today, saying that China violated an accord in Geneva earlier this year by asserting further export controls on those rare earth minerals, and not just for the U.S., but for the world, and warned that the U.S. will not let China wield power over global supply chains.
And make no mistake, this is China versus the world. They have put these unacceptable export controls on the entire world. China is a command and control economy, and we and our allies will neither be commanded nor controlled. They are a state economy, and we are not going to let a group of bureaucrats in Beijing try to manage the global supply chains.
Bessent threatened decoupling from China if China continues this behavior, though he said that's not what the U.S. wants. He noted that staff-level conversations are ongoing now during the IMF World Bank meetings here in Washington, and that he would himself be speaking with allies about China and next steps that could potentially be taken. Bessent also noted that he expects to fly early to South Korea to talk to his counterpart ahead of that all-important APEC conference, where the secretary says he still expects President Trump to sit down and meet with China's President Xi in the coming weeks. Bessent also said it's possible that that 90-day pause on tariffs between the U.S. and China could be extended depending on how negotiations go in South Korea. Now, elsewhere, Bessent said that the U.S. bought more Argentine pesos this morning, and he revealed that the U.S. is looking at creating a $20 billion credit facility that would purchase Argentine bonds. He says that banks and sovereign wealth funds have expressed interest in this. Josh?
And Jen, we also have the Fed Beige Book. What do we learn there?
That's right, Josh. Fed officials lacking that all-important September jobs report given the government shutdown, and so they are taking greater signal from this Beige Book. And we did get some more tea leaves on the job market. According to the Beige Book, demand for labor was actually more muted. In most districts, employers reported lower headcounts through layoffs and attrition, and we also saw artificial intelligence replacing certain headcount as well. In some cases, also, we know that immigration has hurt the supply of labor, and that showed up and impacted sectors from manufacturing to agriculture. So we know that Fed Chair Powell has said that both supply and demand for workers have come down, and it appears that perhaps demand may be coming down or softening more than supply because the unemployment rate has ticked up to 4.3%. Given what we've just learned in the Beige Book, perhaps anecdotally, the labor market has deteriorated since we received official data from the summer months ending in August last we heard. And at the same time, looking at the inflation side of the equation, prices increased. Employers, manufacturers were dealing with higher input costs due to higher import prices. In certain cases, they were passing that on, in others they were not. And we also saw an increase in services prices, which obviously doesn't have anything to do with tariffs. So the Fed in between a rock and a hard place here, as the labor market appeared to have continued to deteriorate over the past period while prices continued to increase.
All right. Thank you, Jen. Appreciate it. Well, markets have been volatile as investors weigh rising U.S. and China trade tensions against the hope for more rate cuts from the Fed and an upbeat start to earnings season so far. Here with more on the volatile stretch in the fourth quarter is Tematica Research Chief Investment Officer. That would be Chris Versace. Chris, always great to see you, especially on set. So U.S.-China trade tensions are in focus. Got barbs being thrown, as Jen was alluding to there. I want to start, though, on the earnings, because you got more rolling in this morning. You had Morgan Stanley, you had Bank of America. They were solid. Investors liked what they heard. I'm curious to get your take on what you're hearing from corporate America so far. I mean, we're early, but what are some of your takeaways?
Well, I mean, as it relates to the banks, and I think we could trace it back to Goldman Sachs, JP Morgan, investment banking activity is robust. We've had a nice, run in the IPO market. M&A activity is good. I think the question we have to ask ourselves, though, Josh, is can this continue? I think we might hit a little, speed bump. Because,
why do you say that?
Well, with the government shutdown, the SEC is not reviewing new IPO filings. So the IPO market might cool in a little bit in the back half of the current quarter, but we have the holiday season, typically a slower time. Maybe this is just a speed bump, and I expect it to continue in 2026. In the meantime, M&A, advisory work, that should remain pretty solid.
Let me get your take on the economy, because as Jen was knowing, we got the Beige Book. Economic activity a little changed, Chris. Employment levels largely stable. You said overall consumer spending inched down. What is your take on the macro here?
I think that, the economy is continuing to grow, in a nice fashion. But I think if you look at the consumer, we continue to have that dichotomy. The Beige Book talked about how higher income consumers continue to spend, travel, lower income, looking for deals, looking for sales, to kind of stretch those spending dollars. But remember, The Beige Book was collected on or before October 6th. We're now how far into the shutdown? So I think there's going to be more data that we need to see. Personally, I like what I see, the helpful hints that we get out of the Beige Book given the lack of data, but it's going to be the flash PMI report for October that S&P brings October 24th. I think that's going to be a lot more revealing.
You mentioned the government shutdown. We're on day, I think it's 15 at this point.
Expected to go to more than 30.
So markets have shrugged that off.
So far.
At what point do you think investors don't shrug it off?
I think, again, the longer it goes on, the worse or the greater the impact, the greater the speed bump. That's what I will say. I've been talking with folks that I know are government contractors in the DC region. They see a pronounced slowdown. Procurements are being pushed out. And as it's been communicated to me, the longer this goes on, the longer it's going to take for those efforts to ramp back up. So, if we go 30 days and then we got the holidays, could be impactful in the fourth quarter.
Let me ask you about U.S.-China trade tensions. Back in focus, Bessent calls out a Chinese official as disrespectful, Chris, he says. He's disrespectful. As investors, you're watching this. Are we concerned? Or I've heard some investors and strategists say, you know what? It's headlines. It's art of the deal. At the end of the day, there's going to be a handshake and a deal made. Because not getting a deal done, too much of a risk.
I agree, and I actually wrote something on Monday that excerpted some of the key points in the art of the deal. When you're negotiating, keep your opponent off balance, have fun, go big. Don't be afraid to use the media. Sound familiar? So I agree that I think what we're seeing here is a lot of pre-negotiation, negotiation going on, and it's ultimately going to come down to what happens in South Korea. So all roads, I would say, South Korea.
Finally, let's talk AI. Dominates the conversation. I thought of you, my friend, because I saw Jared Bernstein. He's a smart guy. He had an op-ed this week, new op-ed. He was talking about the AI bubble, which I know you think a lot about. And here's what Jared said. Jared says, a bubble occurs when the level of investment in an asset becomes persistently detached from the amount of profit that asset could plausibly generate. And Mr. Bernstein says AI investment, in his opinion, fits that pattern. What do you think?
I'm not so sure about that.
How come? Well, you disagree with Mr. Bernstein.
I do. And the reason being is that, when we look back at other markets, whether it's, the mobile phone, the smartphone, the internet, we have to pay attention to what is existing capacity, what is demand for that capacity. And all indications are, whether it's enterprise or consumer, we're still in the relatively, early innings. Not the initial innings of adoption and usage, not the first or second. I would argue we're more like, third inning, fourth inning, something like that. I get a little worried when we flash forward and it's more like the seventh inning, eighth inning, and the rate of incremental adoption or incremental usage is starting to slow. That's when I get worried, because then we risk overbuilding.
I had a smart analyst on the show, been doing this a long time, and I asked him, do you think, you covered mobile, you covered internet, right? Is this another paradigm shift? And he said, not only is AI a paradigm shift, it's going to be bigger than those two.
I agree with that.
You do?
I absolutely agree with that. There's a lot. The easy comparison is to the internet, because it profoundly changed how we work.
And are you saying, Chris, you ultimately think it's as big or bigger?
I think it's, I'll say this. Back in 98, 99, when we were in the baby days of the internet, did we think we would be streaming, paying bills, and all the things we take for granted now? Not at all. So I suspect that there's going to be a lot of incremental applications that we haven't really thought about that may disrupt how we do things. It will cost some jobs. It will create jobs. Net, I think it's a positive thing.
If I'm an investor, I'm listening to this, and I have to, so is the bet, you say ultimately long term, yes, there is going to be material revenue and margins made off all this AI investment and spend we're seeing?
I would say the short answer is yes, but will every company that people are investing in or betting on, will they make it? Not everyone's going to make it.
Pick your spots.
Correct.
Yeah. All right. Thank you, sir. Appreciate it. Coming up, Apple unveils new products with a unique chip. We'll have all the new product details with our tech editor. Plus, why a couple of big bankruptcies in the auto sector has bank CEOs like Jamie Dimon concerned? Those stories and more when we return. Stick with us. All right, now time for some of today's trending tickers. Tematica Research's Chris Versace still with me here. Can take a look at NVIDIA, Arista Networks. Maybe we'll talk a little Papa John's. Can start off though with NVIDIA. It's a chip maker getting an upgrade over at HSBC Securities as it expects the market for NVIDIA's AI chips to keep growing. So this one, Chris, okay. So HSBC, they upgraded NVIDIA to buy. They raised their target to 320.
Eye-popping, isn't it?
Bloomberg says, I'll tell you what that 320 is. Bloomberg says that's a street high, Chris. They expect the AI GPU TAM, total addressable market, to keep increasing. They say beyond the hyperscalers, beyond the cloud giants. That's going to lead, they say, to continuous earnings growth. With this upgrade, by the way, more than 90% of analysts who are paid to tell you what to do with NVIDIA, more than 90% say, you know what, you buy this one. Do you?
I'm not going to buy it because I already own it. So we own it in the Street Pro portfolio.
When did you get in, by the way? Roughly.
After the split, I want to say 45, 60, something.
You're still a believer here.
Oh, yeah. I mean, look, we're still, to carry our conversation from earlier, we're still in a rising tide, lifting a lot of boats. I don't think NVIDIA is the only winner. I think there are others out there, and we kind of position the portfolio for that. In fact, we'll be talking about one of them coming up. But as long as we continue to see the rising demand and capacity needs, I think we're going to be fine. Where I get a little concerned is exactly where this analyst took his numbers up significantly. 2027, that's a big jump. It's 5 quarters out. A lot can happen between now and then. So, we'll continue to update our thinking and revise our EPS expectations for NVIDIA, but that's a big swing.
Let me ask you, as an NVIDIA shareholder, I'm just curious, you see NVIDIA making these investments, OpenAI, CoreWeave, XAI, do you think Jensen knows what he's doing? That's a smart use of capital.
I do think he knows what he's doing. They do have the balance sheet, and they've done other investments in CoreWeave, for example, which has turned out very well. I also think it's kind of a competitive position, kind of reinforcing where they want to play and help mature the market along. So I like that, but is every one of their investments going to make it? I mean, Jensen's smart. Don't get me wrong, but we'll see.
We'll see. All right, turning now to Arista, as Citi highlights a buying opportunity. So this one, Chris, all right, so Citi weighs in here on actually, by the way, Arista Networks, and it looks like Astera Labs. They would be buyers here, they see on weakness. Most on the street like both these names, it looks like. I'm just looking at Astera. Your average target is around 188. Average target for Arista is around 160. Arista, nice run. It's up around 30% this year, and your portfolio owns it. How come?
Well, for a couple of reasons. One, we do like the growth prospects for network as it relates not only to AI and data center demand, that rising capacity we talked about, but also ongoing shift from broadcast to streaming. Remember, it's all carried across the network. So when we look at Arista Networks, we also like their AI partners, right? You might have heard of some of these names, Josh. AMD.
Yes, that rings a bell.
Broadcom, ARM, and a little company known as OpenAI. So, we do like that. And I agree with the Citi analyst that this pullback that happened after a nice win on the networking front by NVIDIA. But again, if we think about the big build out that's got something like 500 plus hyperscaler data centers coming on stream in the next couple of years, we're going to see continued demand for networking equipment. I think the pullback is a nice opportunity for Arista. In fact, I will share with you that we started our position last week. We used the pressure on the shares earlier this week to buy a little more.
We just buy that dip. Lastly, all right, big switch here, Papa John's. We're moving to pizza, Chris. Reportedly facing a takeover offer from Apollo Global Management. It's according to Reuters. Apollo Global, of course, the parent company of Yahoo. So this one, all right, so Papa John's reports that Apollo submitted a bid, Chris. They say within the last week, take the pizza chain operated private. It looks like they are reporting at $64 a share. This is Reuters. Now they're cautioning situations fluid. Reuters saying no deal guaranteed. Doesn't look like. It sounds like at this point anybody is commenting, but you can see the pop in the stock.
Yeah, it's interesting. I mean, it's taken a pizza company private. We've seen other deals in the food space before. The question to me is, are they going to wring the costs out? Are they going to try and accelerate international expansion, right? Because with these restaurant stories, it's all about geographic expansion, whether it's across, west to east in the U.S. or internationally, right? Those are the legs. So they've got to be thinking about this, but that also means at some point they'll have to monetize it, come back out, Maybe they make it lean and mean. We will see.
You a Papa John's guy?
No, that's not pizza.
Leave it there. Thank you, Chris, as always, my friend. Appreciate your time and those picks.
Happy to do it.
We move on. Dan Howley has news for us on Apple. Fill us in.
Yeah, Josh, we just saw Apple this morning announce their new M5 chip. This is the successor to the M4 and the 3 and the 2 and the 1. This chip, Apple says, has improved AI capabilities. That seems to be the entire big piece of the story, at least. They also announced their new 14-inch MacBook Pro and the new iPad Pro and a new version of the Vision Pro. It's everything is basically the same physically, but they get smarter brains, essentially. And AI is wrapped in all of this, especially with the MacBook Pro and the iPad Pro. They say that AI performance is going to be better overall thanks to AI accelerators built into the cores of the GPU. That's a big deal for whether you're developing large language models or working with large language models on your Mac. For the iPad, it gives it a nice boost in terms of performance at a time when they're starting to make the iPad kind of more Mac-like. They launched iOS 26. You can now multitask with it a lot better. If you want to move your window off to the side slightly, it's not going to automatically boomerang back and kind of, you can move things where you want, right? And so that's something we've wanted for a long time. You got a Pro iPad, why can't I do that? Now you can. The MacBook Pro 14, that also gets the big upgrades as far as graphics and those AI capabilities. Apple's really playing up the capabilities that they have when it comes to games. That's been something that they've been pushing heavily, although they're not really a huge player in the space. But really, this is kind of the evolution of what Apple's been doing since it launched the original M1, moving away from their Intel chips. They still, by the way, if you look at their press release today, talk about how much better it is than having an Intel Mac. Not gonna lie, it is much better. You can get much better battery life and performance overall. And so I think that's gonna be a continuing part of the story. The other part is we're waiting for the other shoe to drop in this, which is when we see the Pro, the M5 Pro, the M5 Ultra. They usually do that with all their chips. So this is just the base version. We're gonna get even more powerful ones as we kind of progress through the next year and next few months.
Remind us, then, for Apple, we talk about the Mac and the iPad businesses. How important are they still for Apple, just financially and strategically?
They're very important for them. They obviously, from a financial standpoint, they're the two smallest businesses. Now, that's, 20 some odd billion dollars a year. That's not peanuts, but when you look at, 200 billion for the iPhone a year, it's not the same, right? But it's important because it keeps people locked in the ecosystem. Now, you can absolutely have a MacBook and an Android phone, nothing saying that that's illegal. But if you have an iPhone, chances are you're gonna say, well, I wanna go for a Mac. If you have a Mac already, you're probably gonna get an iPhone. Ditto with the iPad. If you have an iPhone, you're probably gonna go to the iPad. When you have that iPad, you use it all the time, you're ready for a new phone, you're probably
just
gonna say,
easier to stay in the family.
Exactly,
right.
keep it in the family, and I think that's probably the biggest piece of the Mac iPad infrastructure that they have. Also services. I mean, services is their second largest business, continues to grow at a rapid clip. The fact that they continue to add Macs and iPads, keep adding new software offerings, it's a big deal. I think the main thing here is we're just waiting for that next Siri. The AI powered Siri. It's still, months away, perhaps. We were supposed to see it in June. No such luck, so we just have to wait and see. I got to say, though, as far as Papa John's, it is not pizza. Neither is Domino's, but it is delicious. Better than Papa John's.
Well said, Dan. A fair assessment, as always. Thank you, sir. Appreciate it. Well, supertanker freight rates and fees rising sharply, driven higher by U.S. and China trade tensions. My colleague Julie Hyman spoke with Synergy Maritime CEO for more.
Supertanker freight rates surged this week on a hike in U.S.-China tit-for-tat port fees. On Friday, China announced retaliatory fees that, by one estimate, would add more than $7 a barrel in shipping costs for a large crude carrier linked to the U.S., equaling about $15 million overall. That's according to Reuters. Let's talk more about the situation with Stamatis Tsantanis, Synergy Maritime CEO. Thanks so much for being here, Stamatis. So what are we seeing in terms of on-the-ground port fees and how that's affecting your business?
Well, thank you, and good morning to everybody. Thanks for having me. It's kind of a crazy situation, to be honest. We used to have the USTR, and we still have the upcoming implementation of the USTR, which is the US port fees to the Chinese related ships. And the Chinese government last Friday decided, in retaliation to the USTR, to impose port fees and tariffs on US related ships. And that's a multiple amount of money for every port call of US related ships to China. So, I mean, USTR, you could have said, okay, that might be some logic behind the actual amount associated with the port call. But now for our ships, which of course are not affected by that, we're talking about a similar ship like ours, $4.5 to $5 million per ship per call to China. So you can imagine that's an amount which is exorbitant. So this is the kind of situation that we faced, and that came up last Friday.
Are you passing those costs on to customers? Are you eating the cost? Well, how is that working?
Well, that's the thing. I mean, eventually all the costs are being passed down to the customers. So it all falls down the actual chain of things. So it will fall down to the actual consumer, and that's going to make things way more expensive. But it's a very punitive measure from the Chinese government to actually impose this kind of tariffs and port costs to the U.S. related ships, and it's a very how do you say it, confusing situation all of a sudden.
How long do you expect it to last?
Well, the other interesting fact is that while we have all this groundbreaking news about tariffs here and there, USTR, the Chinese ones, the U.S. government is closed. It all coincides with the fact that the U.S. government is closed, so we cannot really get an answer from the U.S. Government officials as to what they're going to do. And we do not have any clarity from the Chinese officials as to what ships will actually be affected. But this measure was actually enforced today, and it's ongoing. So people end up paying this exorbitant amount without having any clarity as to how long this is going to continue. It only makes things way more expensive and complicated for us.
Coming up, we're taking a deep dive into those bank earnings and what they mean for the economy. Those stories and more when we return. Stick with us. Wall Street is on alert after two major auto sector bankruptcies are exposing hidden risks across the credit market. First Brands, an auto parts maker behind names like Fram and Autolite, and Tricolor, a subprime auto lender and dealership chain, have both filed for bankruptcy, shaking confidence in a corner of finance that had seemed stable. According to the New York Times, billions of dollars in loans to First Brands have effectively vanished, revealing off-balance sheet borrowing and double-counted invoices that blindsided banks and private credit funds. Jefferies, UBS, and BlackRock are among those with exposure. The fallout is now forcing investors to re-examine everything from leveraged loans to collateralized loan obligations, often called CLOs, as questions mount over who else might be holding risky money. Now, JP Morgan Chase CEO Jamie Dimon is weighing in, saying on a call with analysts that his antenna went up after seeing what's happening with Tricolor and First Brands. In his words, I probably shouldn't say this, but when you see one cockroach, there are probably more. Dimon admitting JP Morgan's exposure to Tricolor was, quote, not our finest moment after a $170 million charge-off last quarter. There's no concrete proof that this is something systemic yet, but the fear is clear. If two mid-sized failures can ripple through Wall Street's massive private credit market, investors may soon demand far more transparency before the next domino falls. While the banking giants became the latest to benefit from a Wall Street deal-making boom, looking beyond the frenzy of mergers and IPOs, there's caution to consider. Joining us to discuss this and more, we got Christopher McGratty, KBW Managing Director and Head of U.S. Bank Research. Chris, it is great to see you. Maybe start there, Chris, with these auto industry bankruptcies, First Brands, Tricolor. I'm just curious, as an analyst, covers this space. Walk me through how just you're thinking through it and possible ripple effects.
Well, hey, Josh, good to see you again. The credit stuff is something we're paying attention to. Two large, prominent bankruptcies in a short period of time. We're getting more questions on credit. I wouldn't say we were complacent on credit, but this is a not so gentle reminder. But if you take a step back, right, we're coming off a period where credit costs for the industry are at multi-decade lows. So This is, I would say, part of the normalization process. It's a pretty severe reminder. But overall, if you think about the bank's balance sheets, they're in a pretty great spot, right? They got a lot of capital, a lot of reserves. But again, this is something we're watching as we go through the quarter.
Some names in your coverage list, Chris, they reported this morning. I want your take on it. Morgan Stanley, solid. Investors like what they see there. Investment banking was up 44%. Looks like trading was up 35%. What do you make of the report as a fan of the name?
Right. Morgan Stanley is one of our top ideas. But broadly, the biggest banks, JP Morgan, Bank of America, Morgan Stanley, Goldman, the results have been excellent, right? You've seen a rebound in capital markets. All the banks gave updates about a month ago. They've all exceeded expectations for investment banking and for trading. There's pent-up demand, as you're hearing on these conference calls, for activity. And so while there's always an element of uncertainty in the macro, companies are getting more visibility and they're willing to transact. So the results are great. You take a step back and also think about the returns these banks are generating. And our view on the banks broadly, we have this triple crown theme at KBW where scale, consistency, and deregulation are really winning. It's case in point. We're seeing it play out in real time with these largest banks. The ROEs are tremendous. They're high teens, if not 20% plus. And so there's really a lot of momentum going on.
Just more broadly on the M&A environment, Chris, I'm curious, if the Fed is going to be cutting, what does that mean for the environment now and ahead for deal making?
I think CEO confidence is really important to underwrite a deal, right? We're seeing CEO confidence move in the right directions. Part of that's the wealth effect with asset prices inflating, but there is a pent-up demand for activity, and I'll take the banks specifically, right? There's still 4,000 banks, and we're in this window of deregulation, right? The Trump administration has told us they're going to be more friendly towards regulation, and we're seeing it play out. We've seen several large deals consummate this year. I think there's probably expectations that we have a 12 to 24 month window before the potential change in administration kicks in. And so banks are willing to transact.
Let's talk about Bank of America, too. They reported as well this morning. Another name you like, Chris, also in the green. It looks like they beat estimates. That was a 43% jump in investment banking revenue. That's a standout. What did you make of that report?
Bank of America had, that's another stock we really like. The 15.5% return on equity. That's pretty significant. They've got a really important investor day coming up on November 5th. We think, like Wells Fargo did yesterday, we think they're going to paint a picture towards higher returns that are more durable. And so, Bank of America's results were really strong across the board. They had the capital markets, Josh, that you talked about. They also had organic loan growth, which is one of the pieces that investors are really pushing for this story.
What about Citizens Financial, Chris? I'm curious what you made of those results. Investors didn't look too wowed by it. You see the stock here. We're trading down about 1%. Was there disappointment in that report?
No disappointment. I would say it was a well-liked story. So a little bit of a crowding factor, technically. Investors like the story, right? Our thesis is really they're in the process of a multi-year ROE improvement story. So you're going from a low double-digit to a mid-teens to high teens ROE over the next couple of years. What I thought was really interesting on today's call with Citizens is they said the 16 to 18% ROE target that they have for the medium term, that's on track. But they're also not satisfied. They're going back to the well. They're trying to find additional synergies in the business as they grow. And so there's on top of that potential ROE improvement. Again, we're talking multiple years, but I think the stock reaction is just nothing in the report itself, just a bit of a positioning dynamic.
Final question, Chris, as you look through these reports, you listen to conference calls, what would be kind of the read-throughs you would have about what it says about the macro, what it says about the consumer?
I would say broadly, take the two credits that we talked about out. The consumer's in pretty great spot. Commercial credit's been very good. There's been a lot of questions about economic assumptions and the outlooks, and most of the banks are pretty confident. So we're of the view that we're in a normalization process with credit normalizing higher, but at a very reasonable to a reasonable degree. And so there's reasons for optimism going into 26.
Chris, great to see you. Appreciate your time and those picks.
Great. Thanks, Josh.
Well, today would have been the day we received fresh economic data from the Consumer Price Index, but with the government shutdown delaying that report, and many others, investors are looking for different indicators on inflation. One from trying to fill that gap, Macro X, which is estimating core CPI rising 0.27% for September. Join me now, Apoorv Jan, founder and CEO of Macro X. Apoorv, great to see you here in studio. Maybe start here, Apoorv, just for the unfamiliar. What is the mission of the company, the point and purpose? What's the problem you're solving for?
So MacroX was built to measure the world economy, specifically the macroeconomy in real time. And the whole thing was, when I started, so I was a trader, and then I saw we were trading these billions of dollars, and still the economic data that we're trading it on is for last month. It's last month's data that's not released right now. And I thought it's all survey-based, which takes time. And as the amount of alternative data, right, so satellite data, sensor data, source data, that's going up, and people's response rates are declining, it felt like we could measure the world economy in real time instead of 1 month delay. So the whole, kind of in a nutshell, it was like MacroX was built to count faster than the government, but we didn't realize the government would stop counting.
What are the sources of data you're relying on?
So it's many different alternative data sources. So for example, we'll look at satellite data, we'll look at social media data. So are people still kind of tweeting about the price of eggs, or are they tweeting that less? Are they searching, are newspapers saying people are less worried about inflation, or are they still more as worried about inflation as they used to be? So then we'll look at how's the foot traffic to malls. We'll look at like what is the satellite data showing, are the shipments actually coming in or not? So we aggregate all those different kinds of data.
And who are your customers, Apoorv?
So it's the top asset managers of the world who basically want to get a jump on macro.
And since the government shutdown, we're not getting that hard data like we're used to. Have you seen an uptick in demand for your services?
Dramatic uptick, I would say.
Dramatic.
Yeah.
From certain sectors in particular, like who?
Yeah, definitely the macro hedge funds. So first off, because they rely on the macro data, but increasingly what we're seeing is even the equity funds are realizing like they may not believe in macro as much, but macro believes in them. So if there's a there's a big move in macro, like all your risk factors go awry. So they're also starting to talk to us.
So I'm curious, let's dig into it. Your data you have right now. Start big picture. What's it telling you about the U.S. economy? I'm looking at the Atlanta Fed GDP tracker. That's near 4%, but I'm curious, does that dovetail with what you're seeing?
Correct. So what I would add is we were saying that in July because of our data is forward-looking, yes. Yeah. So we were actually very public with it. You can go on LinkedIn and even check some posts. So we were saying the U.S. economy is in better shape than the Fed believes.
What data was giving you that signal?
So once again, we don't try not to rely on any one data source, but because that can be wrong. So what we try to do is triangulate across all those different, as I mentioned, the satellite, the people were going to malls, when you look at the foot traffic, when you look at, they still were searching to buy different durable goods and different products. Satellite data showed that, the shipments were actually still happening. They were a little bit down because of the tariffs, but still happening. So it's the combination of all those different factors and credit card spend was there. So when you triangulate all that, we're like, oh, actually, the economy is not as bad as people fear. The Fed was projecting 1.4% earlier. And then we were consistently saying, we're seeing 3%. And then the Fed, I was at the National Association of Business Economics at that conference, and the Fed finally said, oh, the data has been surprising to the upside. So our clients had already seen that, actually.
There has been this divergence, though, right, that we talk about. Yeah. That GDP hanging in there, but labor market cooling. You heard Jay Powell again this week.
Yes.
He was emphasizing this concern about the labor market. Does your data show that as well?
It exactly shows that. So what was interesting about COVID was there was a structural break, as economists like to call in the market. So in 2022-23, you would see, so that's another thing we track, like CEOs complaining that they have to hand out big bonuses essentially to get workers, and they're hard to retain. So that was really high, and workers were not anxious. So if we actually track kind of based on social media and a bunch of other things, their mental state, how anxious they are they looking for food stamps, they were doing great. So the labor market was amazing, but the overall economy was just neutral. And then slowly the labor market cooled down, so you could see the kind of the demand and supply both for labor cool down, and it went below now the overall economic activity. Can that sustain over 2 years? Not really, because we think eventually the labor market, the fortunes of the labor market and the fortunes of the economy really move together, but it can dislocate for a reasonable period of time. So we are seeing that dislocation even in our data, the hiring intentions of CEOs, so which eventually translates into vacancies, which eventually translate into the actual non-farm payrolls and the jobs gain. So even the hiring intentions are actually below trend.
Finally, we asked about GDP, labor. I got to get your take on inflation. What are you seeing there? What does the trajectory look like? Again, based on your data.
Correct. So based on other data, kind of the ISM prices paid and stuff like that. So people were really concerned, I would say, about good prices rising because of tariffs. We don't see that. So we actually see good prices are not accelerating. Did they rise? Yes, they rose a little bit, but we don't see this acceleration. Secondly, there was this big concern because of tougher immigration, there would not be as much workers, and you're going to see a rise in services. And remember, services is the biggest part of the basket that we consume. So once again, by tracking kind of the worker, mental space or anxiety and all these kinds of things, we actually see that's not the case. So bargaining power of employers is still high, and workers, unfortunately for them, they're not getting higher wages. But that does mean the U.S. consumer is not likely to have high services inflation. So we're seeing inflation more contained than is being expected. Yes.
Fascinating insight, Apoorv. Great to have you on the show. That was great. Appreciate it.
Thank you very much.
Coming up, in the crowded space of value stores like Five Below and Dollar Tree, we're talking to an expert about the best place for your portfolio. Stick with us. Dollar Tree reaffirming its outlook at today's Investor Day, putting fresh focus on the value retailer trade as consumers continue hunting for bargains amid lingering inflation pressure. We're navigating how to play value shopper stocks for the Yahoo Finance playbook. And joining us now, we've got Anthony Jacumba, Managing Director at Loop Capital Markets. Anthony, great to see you, as always. Maybe start for big picture, Anthony, before we get to specific names, because we're always looking for a line of sight into the consumer. You have that based on your coverage universe. So I'm curious, Anthony, generally, based on what you see and hear in your coverage universe, how would you characterize the consumer here? How healthy, how resilient?
The consumer is relatively healthy. I mean, unemployment is still pretty low. Wage growth is still pretty decent. Now, there are certainly ongoing concerns about inflation. It certainly has remained a little bit elevated, but I think that the fact that the Fed is cutting interest rates is certainly a good thing. So the consumer is relatively healthy. I wouldn't say they're in amazing shape, but I would say they're in good shape.
U.S.-China trade tensions back in focus, Anthony. Barbs being thrown here between Beijing and Washington. How exposed is your coverage universe to those tensions?
So to be clear, a couple things. First off, if you're talking about the remainder of this year, really not at all. I mean, folks have already bought all the inventory that they're going to sell over the holiday selling season, probably into early next year. Longer term, obviously, yeah, if you're talking about 100% tariff on Chinese goods, a lot of these companies are exposed. But the thing I will say is they're a lot less exposed than they used to be, right? Because we've seen this movie before. And so when you had the first Trump administration and these tariffs come on, a lot of companies started to diversify outside of China. So for any company that I cover, their exposure to China is significantly less now than it was, let's say, in early April, and certainly significantly less than it was during the first Trump administration.
How were those names, though, Anthony? How did you see them sort of navigating the tariff dynamic, though? Like, what moves have they been making? What levers have they been pulling?
So there's been a few different levers. One is, like I said, just trying to diversify out of China. So maybe sourcing from Vietnam or India, or maybe even near shoring to Mexico if possible. The second thing has been, and they've been very quiet about this, but they've done it nonetheless, is raising prices, right? I mean, they just, you have to remember, retail is a very low margin business. I mean, if you have a retailer that has a double-digit operating margin, they're dancing in the street. So they cannot absorb these tariffs. And so they are passing those price increases along to consumers. And then to the extent that they are, eating some portion of them, they're trying to offset that through cost cuts in other areas in the business. And the one other thing I will say is that some of it, they are kind of pushing back on suppliers as well.
Let's get to some names, Anthony, while we got you. Dollar Tree, it looks like, I know you covered that one. They made some news today. It looks like projected earnings per share, looks like rise as much as 10% annually over the next 3 years. Looks like they see fiscal 26 EPS growth by high teens percentage. What did you make of those headlines and what you heard?
So, look, I mean, at a very kind of high level, when you look at the targets that they set, 12 to 15% annual EPS growth over the next few years, they seem very impressive. The problem, from my perspective, is that they just don't have a lot of credibility right now because they've had sort of this track record of sort of over-promising and under-delivering over the last few years. So it's really going to be very much a show me story. Now, to be clear, they did sell the Family Dollar business. They got a lot more than that for it than I think a lot of folks thought. They got $1 billion. I think they would have been happy with a bag of magic beans. But, that doesn't necessarily cure all of their ills. And they're also doing this multi-price strategy. They've seen some early success with it. I do worry that at some point maybe you lose the uniqueness of selling everything or virtually everything for $1.25, but that remains to be seen. But more than anything, they have credibility issues.
Well, let me ask you, Anthony, because I think you got holds on both Dollar Tree and Dollar General. But if I pressed you, Anthony, I said, listen, in this environment, in this backdrop with this consumer, is there one that's relatively better positioned than the other? Would you pick one?
If I had to pick one, I would probably pick Dollar General. I just think that the management team under Todd Vasos has more credibility and a better track record of actually, meeting expectations or exceeding expectations. It's interesting because, this is not his first rodeo. This is his second stint atop the company. And when he came back, he laid out this turnaround plan, and it did take longer, I think, for us to see the results than we were expecting. But they are hitting on all cylinders right now. They also are definitely benefiting from consumers trading down from more expensive supermarkets, drugstores, convenience stores. So if I had to pick one, I would definitely go with Dollar General.
Anthony, always great to see you, sir. Thank you.
Anytime.
Well, wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.